Everyone wants the perfect hedge. The one position that saves you in every crash, every recession, every black swan. That hedge doesn't exist. Real protection comes from balance, several imperfect tools working together. In this series, I'm breaking down the exact hedges I use, why they exist, and, just as important, when they fail. Every hedge solves a specific problem, not the entire market. If you rely on one hedge, you're just creating a new blind spot. Hedging. Risk coverage, not risk elimination. Gold isn't a crash hedge, it's a confidence hedge. Protects against currency debasement, monetary instability, long-term loss of purchasing power. Fails when rates rise aggressively, liquidity crunches hit everything. Gold doesn't save you first, it saves you eventually. Currencies move when governments panic. Protects against European debt stress, capital flight to USD safety. Fails when the US becomes the problem, global coordination suppresses FX volatility. This isn't a bet on America winning, it's a bet on stress showing up somewhere else first. Tail is insurance, and like all insurance, it feels useless until it matters. Protects against sudden crashes, volatility spikes. Costs. Slow bleed during bull markets, psychological role. Lets you stay invested elsewhere. If tail is making money, everything else is on fire. Sometimes the best hedge isn't an ETF or an option strategy, it's doing less. Look at what corporations do in a recession. When the economy slows, companies don't double down on expansion. They don't open new offices, they don't hire aggressively, they de-risk. They shrink operations to survive the downturn, so they're still standing when growth returns. Investors should think the same way. Reduce position size, cut leverage, move partial capital to cash, stop forcing trades. De-risking isn't market timing. It's capital discipline. Notice something important. Corporations don't exit the economy. They stay operational. Expansion is for booms. De-risking is for recessions. And knowing the difference is a competitive advantage. Bonds are supposed to be boring. That's the point. Protects against deflationary shocks. Equity drawdowns. Fails when inflation is the dominant threat, rates rise rapidly. Bonds hedge stocks, not inflation. Volatility is fear made tradable. Protects against market stress, liquidity events. None of these hedges work all the time, but together they cover different failure modes. Inflation, deflation, currency stress, liquidity crashes, psychological panic. The goal isn't to be unhurt. The goal is to survive well enough to keep compounding. In the next videos, I'll break each hedge down in detail. If you want to see all of this in action, check out our new HedgeHog app. The app automatically calculates the proper hedge sizing and shows how the strategies perform across 8 market scenarios. And for a bonus, I made a video on capital efficiency, how to structure your portfolio so hedging doesn't cost you growth. Because when you position correctly, you can protect your downside without giving up growth. If you want to hedge like a professional, you need a system, not a guess.